for the new projects and go through the whole get to know you process. We run a lot of deals on a weekly basis. In general, top 3 right now, we have 2 properties in the contract, we have 1 LOI pending, and we're underwriting actively in 7 different locations. We're working on a fund, and we are actively seeking to raise 1 project. Second one will get kicked off sometime next week. So our plug, we have a 10 acres on the contract in Georgetown, north of Austin. Last webinar, we did the analysis on this deal. It's a 2 years land play, 20%-ish in IRR, 1.5 years in and out, 7 pref and 70-30 split. All this one, it's a 506C, so it's for accredited investors. Information is on our website. Reach out to us if you have any questions or take a look at it on the web. We also have a top secret project. It's a 506B, can't talk about it. And the only way we can talk about it when we know, so reach out to us so we get to know you, and then we can talk about it. So in general, those are the 1, 2, 3, 4, 5, 6, 7 places we have assets we have purchased. Those are the all the assets that we closed in 2022. We missed the January, could not close anything, but it's okay. We have March, we're closing that land deal, we're talking about it. April, month after, we'll close that Dallas deal. All right, let's get into the trends. So quick context, this section will get each of the slides will have a left-hand side and a right-hand side. So we'll talk about it at a high level, and we'll spend about 20 minutes on the Q&A. We'll share what we know. So what we have done, CoStar publishes a 2023 outlook. I took the what I thought, which caters to multifamily, and then we added our opinion to it, right? So in general, sorry about so in general, when we take a look at it, what we believe that buying, so at least from the massive perspective, we try to understand the market cycle. Then we have a financing or investment hypothesis. Then we couple that with the location strategy. Then we couple that with that product strategy, which is the property. In other words, we try not to buy asset just because I want to buy an asset. We try to buy an asset depending on our investment hypothesis, depending on the market cycle, and depending on the location strategy. So as we do that, we try to take a 3 or 4 years outlook, and we take a position, right? We don't know what's going to happen 6 months from now, but to make a choice to exit from a property 3 years from now, we just have to make a choice. So when we take a look at it, we take a look from the global perspective, then we take a look at the country perspective, then we take a look at exactly the location perspective. This section, I'm not going to talk about the location, but just to want to give you a flavor of how we take a look at it, right? So next for 5 or 6 slides, I'll talk about the macro, which is mostly in the US, what we think is going to happen or what our opinions are, couple that with kind of comparing that with the CoStar report. On the global side of it, I'll just give you a high level, right? The biggest issue that we know already, Russia and Ukraine war, we thought, at least looks like, we'll try to resolve something by Q3 this year, based on all these movements that are happening. And we thought it was Q2 last year, because US took a different position. Now we are taking a different position, then Germany is taking a different position, and then we'll see how that plays out. But still, the goal is by Q3, we have a resolution. But again, if it doesn't happen, your price of your food, it's going to get impacted, especially from the fertilizer perspective. So that's that. Then we have the China COVID supply chain issue. So they're getting better. So it is at a timely fashion. We saw the outlook of it, at least the new number perspective from last year, that Q1, Q2, the supply chain should ease. So by Q3, it should come into the good spot. Now remember, Q3 is popping up everywhere. US-China decoupling, it started last year. When Biden administration came over, and that is still continuing, especially on the tech side of it. So you'll see states where you have high-tech manufacturing, things like Dallas, things like Austin, lots of jobs are moving back. So Taiwan is the big deal, and all the sector in the Taiwan, especially on the high-tech manufacturing, coming to the US. And you'll see that when we talk about tech, there's a manufacturing tech, there's a web tech. So that's that. And the US-China relationship, which is the oil and gas price. So we believe it's getting more tense. As you guys know, that Iran is pushing the nuclear power a little bit more. I think the past two or three big threshold, that is a problem with Saudis. So oil and gas price, we believe, will stay where we are today. So if you are a city like Houston or Oklahoma, we're not expecting any big spike or big drop into the oil and gas, to give you a little jive of it. So macro, again, hot topic, interest rate and recession. So since Q2 last year, we asked 3 questions, or we tried to get a vibe from for 3 questions when we listened to Powell. One was the how fast, how high, and how long. How fast we're going to go up, how high we're going to go up, and how long we're going to stay there. So how fast, we already know. How high, we're almost there. Today, that was a high. There's another high coming up in March. How long, we don't know. And that's the debate of most of the thing. How long? Is it Q3 or is it next year? And you'll see how that kind of plays out. Then the web tech and AI. So web tech, which is, last 3 years, all the technology companies that blew up, and Zoom went from a $200-300 million company to $1 billion valuation, right? So that happened. And then here comes the ChatGPT. I think ChatGPT will be taking out lots of jobs, especially functional jobs. Think about finance, looking at the P&L, figuring out what it is. Think about editing. So think about reading, writing. That sector, it's going to get impacted heavily, and it is here. No way to fight it. So those two, so we should see some impact on those sectors. Not quite in real estate, but on the stock side of it. Lending and real estate, it's a hot topic. And so we'll talk about it as you kind of go through, and I will ignore that one for now. Again, feel free to drop a question on the chat box as we go through. We'll try to answer. But at least idea is that for you guys to understand how we think, how we feel, and how we approach. It could be right or wrong, but we like to be on the side of the market and try to make better decisions. And some, as long as majority of our decision comes out okay, we should be in a good spot. Sanjay, should I go continue with it, or I think I missed a little bit here? I want to talk about a little bit more about the macro side of it. I know you had some. You have your opinions.
Yeah. So I'll just add a little bit. Just the globally, with China-US relationship across supply chain, technology, manufacturing, all those trends been going on for a while, and COVID kind of sped it up. And then the second point on macroeconomic economy, the AI. AI has been going on for last 20-30 years for various things that, it's been being built up, and it's finally here, right? So 2023 is the year, it's here, it's actually being implemented. There's so much with AI that is being generated and done. So that China-US relationship, wherever it falls, right, it speeds up. And in our opinion, 23 will have that big impact. And how that impacts in terms of housing for us in migration, people migration, the patterns and all that. So that's a big consideration, big focus for us to kind of look and review. So for every deal, as we do the macroeconomic review, the geography as well as the population growth, that becomes that much more critical and changes. So these are the things that we read the news on, that we look up the information on, and go for that. So very, very important thing. So yeah, back to you.
Thank you, Sanjay. As you can tell, he feels strongly about the AI. I think there's a lot to it, and we are yet to uncover how many skills will be impacted by that. And that is just just follow some of the stocks who does editing. You'll see AI kicked in, they started ChatGPT, they laid off people, the stock price went up, right?
Yeah, and I mean, to that effect, for all our meetings now, we have an AI note taker, right? Like we have an AI note taker, and as soon as the meeting ends, it gets emailed, and you can follow up if you missed it. And who knows, in a year, this webinar, instead of me, my picture with the AI is doing this presentation, right? That's right up there, that's happening. So thank you.
So let's keep an eye on, similar to ChatGPT, there is a video.ai or audio.ai that can take, you can fed 10 webinars of what you have done, or you can fed that, the model, your voice for, I don't know, 30 hours or 40 hours, then you can mimic your voice and your style and your tone as it comes about. It's just crazy out there. But anyways. All right, so I'll get into recession, right? On the left-hand side, a bunch of charts. I'll try to simplify. Don't worry about it. Just kind of stick around. The right two are the important ones, which is the corporate interest to coverage ratio. Think about DSCR for the property. That means how strong are the corporations out there. This is 2008 recession. They had 2x. Right now, all the corporation that we sit in, it's above a 5x. That means all the companies out there, they have money. That's so for them to go belly up, it's going to take a lot for economy to swing. If you take that in and go to household income to debt ratio, again, we have that upswing of it right here. We are tight. Income to debt ratio is small. Right now, we have income to debt ratio is pretty high. So think about it. Facebook laid off 100,000 people, right? True, it sucks. And my heart, and I went through it 3 times, right? So I get it. But on the flip side, everybody went with the fat check. So are they going to stop going to restaurant? Not really. It's going to continue 6 months and they'll be just fine, right? So think about that. Everybody walked out from a Google. Yes, it sucked what happened, but almost 100% of them went out with a big fat check. So they're good for 7, 8, 9 months. So all in all, we are in recession, and our take is going to happen, and it's happening now, and may last 1 to year and a half. So in a sense, it's a little more mild dip than come back out. So I think that's what our take. So we agree with CoStar that recession is here. It's going to stay for a year and a half. We are going to really see the impact on the Q2 or Q3. Like last year we stopped spending, and this year every house that had the impact, they're really not going to spend. And by the time it trickles down, it's a Q2 and Q3, and everything should kind of go into an equilibrium right there. So, and then which is here that when we go in, and you'll see that the personal savings will go down because a lot of folks will be spending out of their savings that they have, and on the flip side, the real consumption that we have, it should taper off quite a bit as you kind of go. So the demand for the stuff that we have, it's going to go down. So we already see it, right? The house price took a hit, and the demand for the house is going to stack down for a little bit. And because we're going to spend less, because we'll try to stay on a good side. If I don't have to buy a house because I'm not doing a relocation, I will not do so. That thought process will be there. And if I reply it back, net savings should be low to negative. Supply will increase. China will open up. And as you can see, if you go to store, inventory is not a problem, right? And one thing that you can track is the price of the car. A lot of people buy a car, and that's not expensive as a house, but that's a little bit above the typical stuff that we buy. And you can see the secondary market took a nosedive, and the new car price already dropping, right? Class C will struggle because inflation is a price increase for them on top of the increase. So, depending on the location, if you have a Class C property, it's going to struggle a little bit. Class A will struggle. Again, depending on where we have the web tech, not the high-tech manufacturing tech, right? If my Class A building right next to Facebook, right next to Amazon, smack middle of the Austin, I'm not going to see the rent increase that I had before. So in general, we agree with the reduction in the commodity demand that we have. Interest rate and reduction. That's where we differ a little bit, right? So this is the big model, but idea is that here, what we are projecting, that we had the increase today, and market priced it 25 basis points. All the modeling showed 25 basis points, and Fed did that 25 basis points. Powell came down. If you look at the notes at the very end, he said there's going to be another hike. We believe another hike in the next 30 days or 30 some odd days. It's going to be another 25 basis points. At the beginning, I was talking about 3 things, right? How fast, how high, and how long. So how high, we are 25 to 50 basis points there. How long, we just don't know. So the CoStar believes there's going to be a rate hike, or at least one rate cut in 2023. We believe that's not 100%. That could be 70-30. So if we have an asset that is coming on due, I have to refi, I have to sell in Q3, there's a likelihood it's going to slip a little bit. But that's our position. That's how we're modeling it. That's how we're pricing it. And that's how we are also actively buying our assets as well. So we slightly differ. I know CoStar is more bigger, but the little guys got to have an opinion. That's our opinion. So coupling down to the rent growth and demand that we have is that, as you can see, 2021, it just, all the money was pumped. Money has to go somewhere. And when everybody gets money and supply doesn't happen, you squeeze the whole thing out. The money has to come out. That was the free money impact, right? We all have seen that. And then this year, we're going to see the contraction of it as you kind of go, right? I connected with Paul Pable from Old Capital yesterday at the NMHC. It was interesting. that as an investor, yes, we're running the numbers. We get 10, 15, 20%, 30% of it, right? But in reality, he had a friend who, he has a friend who has a freshman kid going to UT. He went to help him out to look at the properties, and he was talking about 1-bedroom apartment for $1,700, 2-bedroom for $2,200, $2,300, B plus, A minus. To make for anyone, how much you have to make to even afford that, plus the bill, plus the other bells and whistles, right? So there is a reason that the market kind of contract a little bit. There is a reason that what we saw today, last week, where that, the proposal of the nationwide rent limit bill was being talked about, right? So market has a way to play it out. So we're expecting the rent growth will be 0 to negative. If you have good locations, maybe you're going to float slightly dip and come back out. If you have a not so much of a good location, we're going to see a negative rent growth. And then cap rate, we're expecting it needs to be right around 5 and higher, closer to 6. And by design, the investors will expect a lot more cash flow. Now, number 3, I don't know how that's going to play out, but we'll try to model at that. So we worked our model. Those are the assumptions. Then we try to find the best fit for the asset as you kind of go. So the question is, which one gives? Does the location win? So cap rate goes down, cash flow wins, or cash flow high, cap rate high, but the location is it's a value add project. So we always try to keep them in mind and try to play and see how we can adjust and find the optimal solution for the project, from the debt perspective, from the cash flow perspective, and from the location strategy perspective. So, and broken deals, it's here. We're seeing it. You guys know about it, and everybody's holding it tight because it's tough to have those tough conversations. But it's already here. We're seeing it, and we expect quite a bit to show up in next 6 to 8 months or so, and that becomes very important, especially if you have a bridge debt with no cap, no rate cap, and it goes Q3 and a Q4, right? So I've seen, good operators, good decisions at that point in time, 3 years. Who knew what's going to happen? We made those choices, and now projects are tough. Capital costs are happening, and then we go. So what our when they come and talk to us, because we have a small pool of money, we do bridge funding. That means if you like a project, if you like the team, and we believe there's a relationship play, sometime we'll do a short-term loan for $500,000 to $1 million just to kind of get them over the closing line or things like that. So we have good friends out there, they're hurting, but then everybody is trying to be level-headed and making a choice, right? No one should tell us that 100% of the investment must be profitable 100% of the time. It's just a dead wrong statement, right? So from that perspective, we try to work together and see. And our take is we agree. And again, we agree it's a broad statement. What we agree in Houston may be different than San Antonio, different than Austin, different than Dallas. And then the last one to kind of couple that with it here, which is the distressed assets, right? So, our storyline has been, here, 1 rate cut, we hire for, longer, wild card again, the Russia and Ukraine, and then rent, we're seeing a taper down version of it, quite a bit. And then at the very end is that, this is aggregate of everything. If you look at the right-hand side right here, right? Again, unemployment rate, distress volume forecast that we have, and CMBS default rate. CMBS default rate's going up, but very less multifamily. All right, just to be clear, multifamily has been one of the strongest asset class. Office is taking a big beating. Hotels are taking a little bit, but multifamily still tend to be strong, much stronger than what we see here. And majority of the distress that we see here is from the office space. And this year we're adding a little bit of multifamily on top of the office that are existing already. So in general, multifamily is still one of the stronger asset class, and maybe the good location, good rent increase, but the debt got the projects. So we're going to see an uptick of it there. So that's we're expecting. So it's quite a bit. It's not going to be 2008, right? It's one of the things to remember. Here, in 2008, we had less money. Companies had less money. When somebody took a one side jab, you're out. But in this case, everybody has money, right? And companies are doing good as well. So it's not going to be a bloody mess going through it, but it's going to be hit as you kind of go through it. So back to it, just to kind of give and kind of an align, it's not going to be as crazy as 2008 or 9. It's going to be some pockets of in and out. And based on what we saw in the NMHC, large institutions, they are gearing up to take over whatever that's happening. So they're going to control some of those, that negative slope that we're going to see. So all in all, we're expecting a little bit of distress sell, some in the multifamily as well. But given the asset class and our objective to save as many deals that we can, it's not going to go down anywhere close to 2007 rate. So in general, we agree, but also, it's here. We agree. We're seeing it, and more would be coming. And then most of the asset that was purchased 2019 and later and breached dead, that's the pool. They're going to get the biggest impact. And also keep in mind, whoever bought asset last year, lenders made them bought a rate cap. So they'll be hurting, but it's not as crazy as what's going to happen to folks of 2018 and 2019-ish time, where you bought a load that floated and your goal is to do a flip 3 years out, right? Typical business plan, buy it, refi in 3 years. That refi will not happen. And that, even though revenue went up, the NOI went down tremendously because of interest rate. And that is going to be the type of asset that we're going to see quite a bit of issues with it. Okay.
Hey,
All
Shreya, good info. Can I
please.
add a couple things and ask a question on the previous slide, maybe for everybody's info? You clarify the apartment demand growth and rent growth difference?
Yeah, and you see it?
Yeah.
Okay, cool. Back to you, Sanjay.
Yeah. So generally for everybody, you see the recession is here, but the individuals and the companies have cash still. It's not as bad. So rents are dropping, the delinquency, the CMBS loans are defaulting. So things are moving in the direction that Fed wants it to go, with that they wanted. Last year, there was a lot of people had the opinion that when the Fed increased the interest rate, it takes a long time for the results to show up. So how long that would be? It could be a long time. Historically, looking at 80s and other examples, it could be 2 years, 3 years, 4 years before the effect of those interest rates show up. But the technology have sped up everything. So these rent decrease in the rent growth, apartment demand growth that we see here is already showing up. The impacts are there. So it's almost like a good news for us in the real estate world, because Fed is going to hopefully change the side sooner than thought before. But we think still, this year, if anything, it'll be flat, and then beyond that, the next year we'll see where it goes. So, thank you.
You go with this distress, Sanjay?
I'm sorry.
Are you good with this slide?
Yeah. No, this is good. Let's open up for Q&A, right?
Let's open up for Q&A. Oh, this is the fun time.
Hey, so look at this perfect timing, 20 minutes.
I'm getting efficient.
Before y'all get into the Q&A real quick, I'm just going to throw out a lot of people asking again about copies of the presentation webinars. Those will be on our YouTube channel. I'm going to post it in the chat. So subscribe to the YouTube channel, and you'll get access to this, past webinars and future webinars. So. And if you've got questions, you can drop them in the chat, or you can raise your hand if you guys got comments, questions, want to talk about what you've seen here. I got to believe with this crowd, there's got to be plenty of people definitely interested to talk.
Mike, as the questions come in, just want to get you a plug. We spent 2.5 days in NMHC over the weekend. I was there, met some great set of people. Be here next webinar. We'll talk about our key takeaways. we had some fantastic conversations from CEOs from the mid-sized lending companies to operators own only 30,000 units to folks who are coming in today and folks been in for 20, 30 years in the industry. So I'll go back to you.
So wasn't a question, but I saw one of the comments somebody was talking about was the the class B, C versus A direction. And expanding maybe more on that.
Okay. Where did they keep it? I
And
think it's also
the impact of different classes, maybe.
got it. So whenever we say it's going to get impacted, right? That's a broad statement. Then that's like as an aggregate level, right? Let's say Texas, and we said class C and A will be impacted, right? And then we have to go down, going back to the very slide that we have to really understand what location that we're talking about, and down to the state and down to the zip code, right? And also then we have to see that in general, Houston, at a broad statement, we should not make any statement because Houston doesn't have a zoning. That's really location by location. But in general, the categories of industry where we're having a job loss, if we have a class A, tend to be a working couple or one individual working who likes the lifestyle, who wants to walk to a restaurant and just everything in a walking distance. If those jobs go away, that segment will be impacted. Example, class A in the oil and gas on the I-10 corridor, not going to get impacted. It is what it is for now until next year and a half, given the oil and gas. But the same type of assets right next to Facebook, right next to Amazon, right next to another company which is just had a cut in California will have an impact. Now again, from Facebook's reduction, the proportion from California versus Austin is different. So, but in general, that if the segment is losing and you have assets right next to those organizations, you're gonna get impacted, right? That's that. That's a different way. That's a job reduction way. Going back to the class C, they come in from the inflation way, right? Think about a working couple and with 2 kids, and they live on a $1,300, which is Houston's average price, $1,300 a month, right? They make $2,500, $2,600, or maybe $3,000. So each of the parents make $1,500 to $2,000 a month, right? Their food has expense. If my gas price goes up, if my price of egg goes up, or my milk goes up, rent stays the same, but I'm going to struggle because I live in a fixed income. My income already increased last 2.5 years or so. It's not increasing anymore, right? That is the issue where you look at a class C. Now it also depends for you, right? And that issue, it's a little bit more general across it, but then it becomes, location specific, right? Folks in Atlanta versus folks in, but class C in Atlanta versus class C in Houston or Dallas area, right? I'll make a broad statement. Some of those areas in Atlanta market, they have systematic issue of not paying the rent. If you look at all the data from any time we have a recession, some of the class C's location, they just choose not to pay the rent, they'll fight for you. They have the culture there, but that culture doesn't exist in a state of Texas, right? Unless you have a data you don't know. So that's the way we take a look at it, that, hey, where's my property? How's the subculture? Then build up way up and see, how they're going to be getting impacted, right? That's my long-winded way of saying it depends.
Mike, you want to read the question? There's a question in the chat.
Yeah. You want to go with it, Sanjay?
Yeah, sure. So, Shra, the question is, are we surprised by the current cycle that you presented, and do you anticipate a repeat of 2021, which is injection of cash into economy without a catastrophic event like COVID preceding it?
I hope they don't inject any more money. I pray to God. Go ahead, Mike.
No, but it was also a bit relevant to relation to 2008 a bit. So
does it? Okay, hold on. Let me see. So I'll try to answer what we think, and Mike and Sanjay, please jump in, right? So for us, history doesn't repeat, but it rhymes. Have a behavior has a way to kind of go about it, right? In this case, what we're trying to run after is 1980s, which is, lack of better words, inflation is cancer. When it pops up, it's bad. It is down dirty. You cannot just hit it one time and it's going to go away. So it's gonna stay, it's gonna linger. So you really have to push it down. You have to kill it, take that thing out, and you have to wait to make sure it doesn't come back. We made a mistake in on the 90s, on the 80s. We went up, went down, then came back up. We did it again. So we pushed the economy at up like a seesaw and a cycle 3 times for no good reason, right? At least we didn't know. We have the data point, Powell is clean, that, hey, we are here and we're not gonna let it go. We think it's out. So that's the jive. It's the 80s, reputation of it, not 2008. And from the finance perspective, anytime we have a recession that touches the finance industry or the banking industry, that's the worst you can have, because they're the deepest and longest. This recession is not for that. So we don't think it's going to be as sharp, as deep, as wide as 2008. And then we believe it's going to be a version of the higher interest rate. And also 2008, we did not have iBuyers per se, right? We did not have those institutional, or the multifamily segment wasn't as built up back then. Now it's built up. So before bottom falls out, we have a class of investors that they are going to buy up everything and equalize the market. So in general, a version of 1980s with the high interest rate, maybe a short circle of it, but I just don't see how that's going to replicate a 2008 version of it.
Yeah, and to add to that, and just to be transparent, no legal, financial, or tax advice here. We are just giving our opinion on what we are actually doing. So just an FYI. But yeah, I think in my opinion, like this high interest rate that some people, sometimes bigger groups, sometimes a smaller group of people have been saying, interest rate have to go up for almost the last decade. And, earlier it was one thing or the other, COVID, and before that, just the recession and things that kept happening that prevented from Fed from just being able to increase the interest rate. And the whole globalization kept the inflation in check, because effectively prices kept falling because we were importing cheaper labor from other places. So I think it's a very different. The technology have sped up everything. So in 2008, 2010, what may have spread took 2 years to spread in multifamily. Now the infrastructure is that more efficient, so everything spreads quickly. If somebody is in a trouble, a lot of people find out about the trouble and they are going to rescue it, just because the technology difference and spread. So I think it's a little bit of a confirmation with high interest rate. Finally it's here, not a surprise. Injection of cash, I don't think it'll be there, barring a black swan event. And we've had a black swan event every few years, as opposed to once every decade or every 2 decades. So but it's a different black swan event every time. So barring a black swan event, I don't think there'll be an injection of cash. And Feds have learned a lot of lessons in the last 30-40 years, so they're trying to go after that.
Yeah.
Thanks, Sanjay.
Yeah.
We can go really geeky about that one. I think one of the reasons that we're looking at it when the money was coming in was that when the Feds or when the leaders of the country makes a choice, what they do, they go to the business school, then they look at different financial theory and they do it, right? The problem is we believe in financial theory that has balanced the balance sheet. Some of the European country, they use another model called modern monetary theory, where you can print money and still get away with it. And we had a little leaning towards that, and all of a sudden money came in, they poured in, right?
So perfect. The next question here is, I'll lean into it a little bit, but what type of debt are you securing right now for value add deals? Floating, fixed, or floating with a cap? And I'll let you kind of cover it all, but during last year, we actually, as a company, leaned into a little bit different process for debt when we saw the things were changing quickly. We actually did a few deals where we leaned into some recourse debt, which probably many people would be surprised. And but it allowed us to continue to do some deals, maybe a little smaller, but to do deals where we could go with a bank, and the banks or credit unions were much more flexible, willing to work with us and come up with a different process, you know, to approach the debt in a different way than we were going in one other deal. So we've kind of gone through different cycles, and now we're into a new cycle on debt as well. And I'll let you go ahead, Shreya, and share more about kind of that cycle we've been going through and where we are. Or Sanjay.
Mike, thank you. No, this is a good point. Sanjay, you want to add something to it before I go?
Go ahead. You go ahead.
So kind of recapping a little bit more, you know, we try to understand the market cycle, and then we have investment hypothesis, and then we go buy whatever that we buy, right? So last year we followed a version of it, right? Investment hypothesis was we're gonna go bust, we just don't know when, right? So to be on the side of the market, everything that we buy must be on a fixed debt. What happened? We buy everybody up until now, most of us that we bought asset, we buy on a pro forma, right? That means I get to buy big stuff. The moment we say we're gonna buy fixed debt on a T12, that means we have to buy smaller stuff and we have to take a recourse loan, right? And that's what we bought all the things, right? And now going a little bit more on a tangent, we have a rule within the massive organization that when we do a deal, when we buy an asset, depending on the size, the GP total team must have 2 to 3x of the net worth needed for that deal. That means if you buy a $10 million deal, our total team put together must have a $20 million worth of net worth. If you buy 50, must have 100. If you buy 60, must have 120. That gives us a little bit more cushion when we go to lender and negotiate. At the same time, every time we do a deal, we look at the working capital of that deal, and we say, okay, between 2 to 3 months of liquidity beyond what's assumed in the model, we should have in our pocket. So we don't have to do a capital call, right? So that's one of the principles that we follow, which is extremely unlikely you'll see others will do. That pushes out a very tight corner, but it also makes us try to make a better decision, right? I don't want to be too aggressive where the working capital is $2 million. We look at the team, no one has $500,000, right? If something goes side, we're in a tough bind. So we kind of manage that. Now back to it, following the 3 things we talked about, the feds, how fast, how high, and how long. So when we bought all of our properties right now at the max, we have what, 6%, minimum we have 3.75. So Q3 and Q4, we took a decision, we took a position where we believe we're on the top end of the market. So no more recourse, everything should be buy on a non-recourse. So right now, when we look at deal, we run through 3 decision hierarchies. First one, we would like to put a bridge on every deal we can, if we can get away with it. And the second, best choice will be for us to get a new debt. And the third one will be a loan assumption. The gap between the 2 and the 3 is pretty wide. But again, depending on the deal, we run all those 3. And if we have to take a recourse loan, we'll do so. We bought the land in the Georgetown. That's a recourse loan for the land loan, which is okay because our team's balance is strong enough to take it. We feel comfortable with it. We'll do it, right? So again, it depends on the deal, depends on the thing. We just not look at one way. We look at the best financing option for that deal that mitigates the risk and the team, based on what we think at that point in time. Good question, though.
Very good question. Yeah, that's a good question.
And that's a loaded question too.
Yeah, and that's one of the important thing today. Very important thing. So,
I mean, we make a lot of decisions, right? I mean, from the FP&A perspective, everybody here who worked in finance, especially on the planning and appraisal, and I work at Shell. We looked at portfolio, 20, 30, $40 billion portfolio. We have hundreds of best in the class, best in the brain, running models, figuring out the projections. And 80, 90% of the time we are wrong, even 6 months out, right? And then we're trying to make it 3 years of forecast. What we said that, look, as long as majority of the assumptions coming out better, some of them will go wrong, which is fine, but directionally, we are going to be okay. So.
Suhasini asked a very good question. Very, very good question. I love this. If demand and rents are going down, what is the value in investing in multifamily? What is the basis for expected ROI? So, Shrai, you want to go or you want me to go?
No, you go first, man. I mean, I see the excitement. You go first, then.
This is a great question.
So we'll debate.
I need to drop it right at 7 o'clock,
Okay.
so I'll
answer
lead you to it. But so number one is the deals we underwrite, and a lot of multifamily players that they underwrite is, you look at the T12 and then you look at the T1, which is the rent they are getting today on the new leases, but not necessarily that's the rent across the board on all the leases, right? And that's what the new buyer is looking to do to burn off that loss to lease or old leases. And, rent may be going down or flat or not going up as much. You have other income. That other income can be 10 to 40% of your just the rental income. And that's huge, because that other income comes with no additional expenses. So, we and a lot of the other players have that upside there, right? That's one thing. Second thing is, so, there are some markets where the rents are going down, like Austin. Austin is one of those where rents are actually down, but like Dallas and Houston, I don't think rents are down. Rents are still going up. They're just not going up as fast as they did in the last few years, right? So the key there is, as long as the rents are going up faster than your cost, you have a value add, because you have a net, your NOI has an increase, and that's the value add still there. And the third thing, of course, is a financing play. The current owner has, what sort of financing, their loan coming due, interest rate going up, all kinds of situation. So, of course, NOI basis, you don't look at the financing. NOI is NOI, but when you look at it as a business, which has a financing component, that financing can make a full 100% difference. And the McCallum that we just closed recently was a 100% of financing play. Our purchase basis was very good. It was below market and the next deal that's going on the market, but financing is what carried that deal to where it is. So Shrai or Mike, I'll leave back to you.
Thank you, Sanjay. And I know you got to go at 7, so thanks, man. Enjoy your dinner with her.
Everybody.
Daughter.
Yeah, thank you for joining.
No problem. Please say happy birthday to her as well from all of us.
Yeah, will do. Thank you.
Thanks. Okay, so it is this, how should I say it? Full context. Us, Mike, Sanjay, and I, and also Trevor, we tend to have a different ways of taking a look at it, and we love this debate. So that was Sanjay's answer. I'll give you how I take a look at it. For me, buy price and sell price. I mean, buy price to me matters, but not a whole lot. What it matters to me is the sell price, because what we're trying to do really create value for the capital that we deploy, right? So I am a guy for margin. I mean, my job is looking at how much of a value we can create, and then when we exit out, can I pay that? Can we pass that on to the investors? So back to your question, yes. When I do the modeling, do I care? No. What I'm going to do, I'll go to my model and I'll plug in the number. It's a flat rent growth for year 1. Another rent, then a positive rent growth in year 2 and a year 3. We'll run the model. If the model tells me to pay a price where I can pay investor a healthy amount of return, I'll go make the offer. So some people, some of us would get all emotional about it, but it should be unemotional, economical calculation. As long as margin pans out, we'll do the investment. If it doesn't, we walk away. That's on one side. On the other side is we have billions of dollars of market size. We should be able to find project that fit investment requirement or our investment hypothesis. We just have to be diligent about it, look for the deals. So short answer is yes, you're right. Just from discretely 1 year perspective, we should invest, but we tend to hold it for 5 years. So we have a step up, and also we model that in, and factoring in that slide to no rent growth, then increase rent growth, then the financing play. As long as we get the return and we feel comfortable about it, we'll do the investments. Good question, though. Very awesome questions. I think we are almost at time. So Mike, disclaimer that we go over.
Yeah, no, that's great. Go back to no, sorry, Shar, the next week's plan. Sorry.
Oh, yes. Thank you.
That's what I was looking for. Yeah, so I don't know if any of y'all are familiar with, NMHC, but it's, the national, multifamily, community basically. And they did a big conference out in Vegas this week. Schreier, a lot of other people were out there. Schreier, hung out with some of the big wigs out there, and was a good time. So a lot of people that people know here, is Sumrock and Cardone and all the others are out there, hanging out with massive capital. So our plan next week is we'll recap, and we'll have probably a couple people join us, maybe sort of a panel discussion for next week with massive capital a little bit. It won't, be overlooked. We'll have a few people come in and share their perspectives, takeaways from the conference. And it actually is more as well, kind of a build on to this one. It's what does it look like? What was the reactions of everybody coming out to that event? And what are people going away with that from as well? So join us next week, same channel. I don't know, what is that, same back time?
You have to register, right, Mike?
So we'll be here, and we'll have I think that's it right now. And if anybody wants to hang out, you want to just chit chat with us for a little bit, we'll hang out here and chit chat. And anyone that needs to go ahead and take off. But we're gonna hang out for another 15 to 20 minutes, and kind of the after party, I'll say. So we're gonna take a 1 minute break here, and call this the end of this meeting, and then we'll start the after meeting right after. So thank you all. Anything else, Schreier?
No, hey, we really appreciate all the investors and everybody we spoke, and thank you very much for supporting us throughout the path. Throughout our journey, and we really appreciate it. We are as good as in all of our partnerships, so we tend to talk openly, and here we go. We share our thoughts. Our plan was to whole month of January to share what's our philosophical approach about what we do. And then you'll see how it kind of plays out throughout the whole year. And as we see, and our goal is to share what we see here. And you are welcome. You're always welcome to come join. Always welcome to reach out. And we have a great set of team. And I can't appreciate enough for all the time our team members spend at a daily basis. It's just amazing. So hey, reach out to one of us, and we have more team members coming up, and it's more exciting as it gets. And I just puts a smile on my face every time I look at our team. So thank you everybody.
Yeah. Thanks again. So I'm going to stop this recording, and then we'll start a new one for the after part. We kind of learned. You can't hear me very well,
huh? I hear you, Mike.
Okay.
And I have the fat finger issue. I'm not going to touch anything. I didn't touch anything today. Give me a second.
We'll see who's hanging out for a bit with us. Any questions? You guys can unmute yourself. Bibi, I see your hand up.
Yes, hi everyone, and thanks for the presentation. It was mind-blowing.
Turn off my music, sorry.
Yeah, I just want you to elaborate more on, because you said the decision for you guys to take the East, the Dallas property, the one you just purchased, is it I can't remember the name.
Yeah, McCallum.
Yes. Yeah, the McCallum. It was based on the debt. So can you elaborate more on the debt? Was it a recourse or no recourse? What percentage, interest rate, and all that? I want to understand how that's played a role in you taking up the deal.
So on the high, so usually deals that above 30 or 40 $million or higher, it becomes a finance play or finance as a crucial. Yes, Mike?
Can you take off the presentation?
Oh, yes, of course. You want to share? Or
No, just stop sharing.
Got it. Done.
Very good.
Cool. Okay, no, thank you. So that deal was, I'll give you in general number, right? It was $60 million deal, $30 million of assumption, $20 million of one pref check, and $10 million of retail LP, right? From the, if you look at the finance perspective, the biggest return that's being asked is been required is the LP investors, right? Second biggest is the pref check, and third biggest is the bank. Banks wants to take the least riskiest position, and they say no big deal, give me the cheapest amount. That's why most of the time loans are cheaper. That was a non-recourse loan, right? Then the second one is the pref guys. Now every single time someone invests, they have an expectation, right? On the pref checks, they want to get more than the market, probably about 3 or 4 basis point, a full percentage point higher, but they want to deploy bigger capital, right? They're like the 401ks of our institutions, right? As long as I beat the inflation, as long as I get a little bit more than inflation, I'm okay. In this case, Walker Dunlop was the institution. They came back and said, I'll give you $19 million, but I want 12%, right? All of a sudden, they are bringing in 80% of the, almost 70, 80% of the total equity, but the negotiating was, 12%. Then we have a bunch of stuff in between, but 12% is their expected rate of return. And when they gave the check, they also ask that I'll give you the check, but I need to make sure your team is big enough, strong enough, has enough human capital to manage my project. That means your balance sheet got to be XYZ. I think total balance sheet for the GP team who carried the loan is almost 100 million. And then second thing is you got to have the human capital. That means Schreier and Mike, I know we trust you guys, but it's a big asset. Who's going to really manage at a day-to-day basis? Where's my construction manager and where's my asset manager who must be full-time in your organization? So on the Hampshire team, we have a full-time construction manager who manages all the CapEx, and we have a full-time asset manager, and it worked out. And this project level, it's about 17 IRR, 16 IRR was at the project level. Since Walker Dunlop took 12 IRR, all of a sudden, the $10 million gets a little bit extra. That's because they're taking 12, and I'm taking 3 more IRR and pass it on to the LPs. And that's how we took a 15, 16 IRR, which is okay project, and made it better for the LPs and for the pref checks and the project work. So those are structured finance, and there's a lot more to it in between how we structured the pref and the point, all this other stuff. But in general, your team, and I start with the team, right? Your team has to be very comfortable running a deal at that size. In other words, they have to be been there, done that on the structured finance, so they know how money is in the money will work. They know how the capital market will work. They know how to negotiate, with the big boys like Walker Dunlop to put the right, assumption and the right parameters of the loan to get this deal, right? So that's how it worked out.
Okay, but it feels like you guys were over leveraged, in my opinion, which is it kind of adds into the ROI. If you guys are giving the other guys 12% ROI and the other investors 15%, I think that's what you said. I can't remember, but
no, project level it's one thing. LP level is another thing. At the project level, it's about 16 IRR. The 80% of the money got 12, then 20% of the money got 24. So our LP return was about 23 something or IRR on this one.
Oh, nice. Okay. Right. I get it now.
The project has to make sense, right? The risk has to make sense. What is our risk? So typically when we take a partnership, we got to ask like, look, the way we have to model, the LPs are hiring a C-level team for 5 years to do the project. What happens if the C-level messes up, right? We're buying a $60 million company, and that's the same question prep asked. I'm going to give you $20 million. It's double the size of the $10 million. What if you mess up? So if you mess up, don't do this. You get to go. I get to come and pick it up, right? So we have a risk. We are incentivized to make sure the project delivers, right?
Yes.
Which is also a thing that usually, as a general partner, as an owner operator of the assets, we like to have as much of a control as we can, and that means I have to believe in my caliber, or I believe in our team and the forecast to let somebody else fire us if we don't do the project right? So it's a slippery slope, but we feel comfortable with it, but that's why I did it.
Yes. Thank you so much.
No problem. Good question.
Yeah.
Sure, Balaji here. In the
Hey,
same
Balaji.
deal for the pref guys,
Mhm.
which class of share they are? They just get 12% and then you exit them, or they'll get the benefit of profit also in the end?
No, they cap out at 12.
Oh.
That's it. So
More like
they
classic.
start from the zero. They get the first dip of the cash flow 5-6%. Then we make them up 6 and a 6. Sorry, 7 and a 5. We will make them up, and we calculate at a monthly basis. If we skip a month, then we don't catch up at all. We catch up at the very tail end of it when we get out.
Mhm.
So we have some flexibility built into it. It's not like I have to pay you back out all the time before anybody gets.
Good.
Yeah.
So that's also good for the LPs or in general for the
Yes.
non-pref, right? Because you pass on the profit.
And
Yeah.
that's very tight for the GPs, right? We're like stuck in the middle. If we do wrong, we're out of the game. We do have to do right? So that's a risk, and oftentimes a lot of us will not feel comfortable with. Very similar to oftentimes as a general partner, we're not going to sign recourse loan. I mean, people who've been in the game, they know recourse loan is like a taboo, right? But we are just being happy. Deal works, let's go take a recourse loan. Deal works, take another one. So.
Good.
And- Yeah, and the same with the preferred partners, like the private equities, they will have rules, but it actually is supportive both of the GPs and the LPs, because they're creating a system that makes, have to perform to certain levels in certain ways, right? So as long as people are willing, and that's a big difference, I think it's a lot of ego that keeps people from wanting to do those type of partnerships sometimes. And, if once we are able to get into that concept, it really supports us, it supports the LPs, and makes the whole deal more functional and for everyone.
Yeah, totally makes sense, Mike. Yeah.
I mean, yeah, so that was just for everyone as well to kind of understand why that makes sense from an LP standpoint as well.
And also to couple that, right? For us, if you think about it, we need to buy in every single market cycle. It's a buying cycle, but not the way you bought it on the previous cycle, right? Last year at this time, or year before last, this time money was free. Feds were giving a negative interest rate, right? Everybody had money. Money, no big deal. $30 million, you got it tomorrow. 60, you got it. Year before that, it was all about institutional play. They will leverage up to 90%. Now, given the forecast that we have, to get the deal done, it's a happy marriage between those two. Now, if I'm stuck with that old, and I bring in one big guy, give me 90%, 95% leverage, and I bring in only $500,000, get the deal done, those days are gone. Then those days are also gone where I leverage the deal 60% or 40%, and I bring in 60% cash, because equity is tough, right? But now it's a blend between those two to make sure that we do this stuff right? So just can't get hung up on one way. So we have to think it through what's the best way to do it. Cool. Trevor, you've been quiet, man. I like your wisdom.
Yeah.
And Trevor is like this guy, this is so cool. I mean, it's like whatever that we're gonna take a look at it, some way, shape, or forms, he knows about that deal. This is so cool. That's I don't know how else to say it. Like, Trevor, how many deals you have done? 20-some deals?
22.
Okay. So for someone to do 22 deals, how many deals he has to go through to do 22 deals, right? Just think about that for a
Yeah,
minute.
probably. And because some of them I did just on Charcoal or other places, I probably looked at 500-600 deals.
That's a lot. I mean, this is a lot. So, but hey, that's why. I mean, look, Trevor knows everything. We had a call today. We looked at the deal. He goes, "Yeah, I know that person. I know this deal. I know this deal. I have information. I'll help you with it." It's cool to have a team member like that, Trevor. Thank you.
I'm excited to be here. Complement each other. What I'm good at, you, and vice versa.
Appreciate it, man.
It's exciting.
Balaji, you in Austin or here in Dallas? For some
Yeah,
reason-
I'm a friend of Trevor. Asked
Yes.
me not. Yeah.
Okay.
So we both
Yeah.
meet.
Half of my trees are in my front yard.
Oh, Mike, I forgot. I talked to Ashley. And so he came from Florida to Austin to look at some houses, and he got the snow, and he lost power. Man,
Yeah.
Austin gave it to him today. I tried to talk to him, like, dude, I don't want to go to Dallas no more. I'm done.
Luckily, I have power still, didn't lose power, and I have a tree that's over my neighbor's, and every time I hear a crack, I run out and go, please don't hit his house.
Man, I
Yeah.
still can't believe that warehouse that I had in Baytown, the
Yeah.
building is gone. Like, it's like 7,000 square foot. The building doesn't exist anymore. Nothing happened to only my neighbor on the east side, something happened. His warehouse was gone. My warehouse was gone. Rest of the neighbor is fine.
Yeah, tornado.
Tornado, man, it's crazy.
Mm.
Oh,
So I guess Ashley's now wondering whether he wants to move to Austin or
no,
not.
he's out. Based on the way he reacted, he's not coming back to Austin. He's going to invest in the Texas area, but he checked out Texas with the big X. He's gonna go to Florida.
He's going further south, huh? Yeah,
So it's
that's cool.
I
Oh,
think
Vivi has her hand up again.
Oh, go ahead,
Yes.
Vivi.
Yes, I'm just taking the opportunity since nobody's asking. During your presentation, we're talking about the class, A class and C class as being the most risky right now, based on the what's happening in the microeconomy. Now, my question to you is, we are seeing in some of the markets that the government is helping out the C class. So in my opinion for that, is that not a safe market right there, since the government is stretching out their hands to support the C class?
I would say that's a very broad statement, which is a statement that makes sense, but then have to bring it down to, what exact location that I'm trying to invest and whether I'm fighting against it or not. If I'm New York, I'll be worried. If I'm California, hell yes to that one too, for right reasons. If I'm Texas, it's a red state. Do I really care? Absolutely zero. Right? When I go to Florida, it's a red state. When I go to California, I worry. It's a deep blue, right? And they're going to support that. I'm not saying, again, I don't have any political side on it. I'm just saying how it's going to play out. So depending on where you're going to invest, you got to watch out for, what the rules are doing, right? For us, we don't want to fight the feds. We don't want to even, whatever they say, that is it. There is no feelings about it. Whatever they say, what signal that they give us, that's there. Second one is the state level. Whatever states are saying, we're going to take it and run with it. There's no way we're going to put a project decision that goes against the Fed, hoping and praying it's going to play out slightly differently, right? So take yours, then ask the question that I'm going to invest in XYZ zip code, buy that particular asset, how that asset gets impacted by the decision at the Fed level, right? So you have to bring that rules down. So, so that's going to depend on location that you're going into.
Okay, thank you.
Now, since you talk about risk, right? So for us, we buy risks. And I also think that when we talk about the risk, we assume that we understand the risk. But the definition of risk has a technical definition and my own personal, definition to it. So when we talk about risk, my ask will be, whoever's saying whatever risk that we think, let's qualify that and then try to make a little bit more quality decision as you kind of go, right? Everything is risky. I walk up on the house is risky, right? And then question is, but we'll still take the chance to walk the house. I go down the stairs, people fall down.
Yes.
I breathe. That is a cost of living, and that is a risk. So we just have to be cognizant about what risk we talk about, and what then we kind of get in it, right? So.
Thank you.
No problem. This is fun. Good conversation.
Yeah. All right.
Mike, I want to share this one. Okay. So somebody asked us, or oftentimes we get into some conversation that what will we do, hotel conversion or not, right? I always been a gun shy for hotel conversion, office conversion, because one, it takes a quality, it takes a certain skill. Because, when you talk about I want to do a construction, everybody has done construction. Then you ask, what is it? Is it construction on paper you have done, or construction on a hard, like the horizontal vertical? then you'll see, how the kind of skill set kind of differ, right? This is from the CoStar. I found it really, really cool. This is the office to multifamily conversion in the market, right? This is like a quadrant, 4 quadrants. This one of the office premium remains. That means if you have an office, you want to keep the office, you don't want to convert. And polar opposite will be this market. If you have an office, you just get out. Right? It is, you're not supposed to have an office in this market, right? And in this market, there is nobody here. That office premium is there, right? But here in these markets, that seems to be office premium went away. That means what I used to get paid versus apartment that went away, and this market opens up, right? And you can see such a hand. I mean, everybody's at the borderline. There's not that many problems because if you go Philly and Chicago, so if you go northeast side, you will get some of the assets. But down south, I just don't see anything where we can convert the office. And so, hey, our hypothesis for different reason came out to be right. So don't do office if we don't have to. Conversions are tough. So I thought I would share that with you. And I was looking for hotel conversion. I could not find it. If anyone has any hotel conversion data that tells you market by market, I would love to have it. Please let us know. I'll buy you dinner. Offers on the table. That's the other one.
But it's interesting, sure. If you go back, it's 2019 versus 22, and imagine like 20 like in 2020, it looked a little different, and now it's kind of returning back in 22 and 23 to offices are coming back to some different premium than they looked like in maybe 2019 and especially 2020.
And office, the thing is, on the office, the lease, all the leases are long, right? Even though I don't want to do it, I'm structurally stuck with it. So the step down happens 2, 3, 4 years out. As I used to remember a lot of heavy debate, if it's going to come back, it's going to come back, da, 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 da. And 100% will come back, maybe more come back, right? I was always in the school of thought it will not going to come back anywhere close to where we were. So it's interesting how that's happening. So I thought I'll share that with everybody. Good questions. Okay, that's all, Mike.
All right, let's
I
go.
gotta go. Okay.
Yeah.
Thanks, everybody.
No, thank you.
Again, in the future, if you guys stick around, you got any questions, you want to chat about anything, whether it was on topic, off topic. I mean, a few weeks ago, we actually spent about an hour talking about health and other things, health and wealth. So
yeah,
everything is open in the after party. So thanks for thanks for sticking around, and we'll see y'all soon. And see a few people in here. I got to do some follow-ups on, but great catching up and great having y'all tonight.
Hey, Mike, before I go, I'll follow up with the Vegas deal with you later tonight. I'm almost done with the checklist before I forget. Okay.
Okay.
Thank you, everybody.
Good night. Take care. Thanks.
Good night.
Thank you, John. We're gonna be connecting with you, John. I got you on the list, man. So thanks a lot.
Bye, everybody.
Sir, whenever you need me, just a phone call away. Thank you.
I know we're gonna get some. All right.
Bye.
You have a great night.
I was muted.
Oh.
Are you meeting again?
No, this was, so the meeting was from 6 to 7. And then this was just a little discussion after the meeting.
Oh, okay. Thank you.
But the
Yes,
recordings
yes.
are on if you go to our YouTube channel, and if you signed up, you'll get a copy, but our YouTube channel has all the recordings. Do you have our YouTube channel?
I can probably find you.
I put it in the chat. If you want to, you can just tap the link in the chat and sign up there, I think.
Okay. Yes,
Mike,
I will. Thank you. Did you guys
sorry.
discuss any deals?
Say again, Cheryl?
Do you discuss any deals?
Tonight we were talking more
Can you
about
break down?
the market, direction of the market trends. We didn't discuss any deals tonight. So it was a little more on the educational side.
Good. Awesome. Yeah, it looks like inflation might be improving. I was listening to a market report today.
Oh, okay, awesome.
Yeah, I don't know if it's just, hearsay, but so I hope all is well for everybody.
Yeah, thank you. Thanks for coming, Cheryl. We'll take a look at the recording and hope to, see you in here on future. We're gonna be doing a review next week also on kind of some findings and feedback of NMHC that people went to the conference. So I think that'll be really interesting.
Oh, awesome. All right. Will I get a text again?
You should, yes. You should be in the system. You should get a follow-up, yes.
All right. It looks like Solana is up right now. And a couple other ones. BMX, I think. So if you guys are doing any trades, let me know.
Okay. Thank
All
you.
right. Thank you. Nice meeting.
Nice meeting you. Bye-bye.
I'm an investor in Boston. Okay.
Oh, okay.
Yep. My company is Your Avon Girl, Cheryl. Your Avon Investor Girl, Cheryl.
Oh, yeah. Okay, thank you.